And I'm very honored and pleased to welcome you and moderate this panel. It's a humbling moment in my career because you're so esteemed professionals. And yeah, so what we want to do, the way we're going to structure our conversation is going to be on two ways, because we have a wide and varied audience today. Some of them are basically dealing directly with end investors and savers. So we're going to talk about the bias there and how we can help them. And some of them are large asset owners. They're investment professionals. They manage money. And it will be interesting to see whether those more sophisticated investors are free from biases. But let's start first with the end savers. And we put that into the context of retirement. And so I would like my first question go to you, Alison. You are CIO of a large superannuation fund in Australia with 700,000 members. So I have two questions. What kind of biases do you see your members doing that may impair their ability to reach their financial goals for retirement? And the second question related to that is that do you see different biases depending on whether they are in the accumulation phase or in the post-retirement phase, which actually Richard told us this is a new issue as well.
Thank you. It's a pleasure to talk to you this morning. There are many biases that we observe in our member base, but if I choose just three that interact across all of the decisions that are important in retirement planning, I'd have to start with inertia, or the status quo bias that Professor Thaler referred to. And I think Australia's compulsory superannuation system really examples the insidiousness of this bias, because despite having automatic enrolment and mandated contributions and a choice architecture, only 12% of Australians have ever actually exercised choice, and that's over 3 decades of our system in operation. And the system has also had to resort most recently to further regulation to counter inertia in small account consolidation as employment employment tenure has become less static in Australia over that period. I think the second bias is one that really is a systems issue, but one that is particularly natural in pension systems, and that's short-termism. I think it's particularly natural in pension systems because retirement is a pretty abstract concept for most people until it's upon them. I guess it's a little bit like hearing on the news that there's an axe murderer in your neighbourhood and then opening the door to find him standing there. It's quite a different feeling. So the preference for disposable income, as an example, in the early phases of accumulation is particularly erosive because in that stage your contributions matter a lot more than investment returns to building a balance. And I'd say the third bias is the bias in regret towards loss rather than opportunity cost. And we see that manifest in surveys of our member base with continuous and broad-based preferences for capital safety. And that's despite the fact that our average public sector accumulation member is a 39-year-old female, and our average Defence Force accumulation member is just 25 years old. So loss aversion definitely leads to less wealth accumulation than risk appetite or capacity to take risk would suggest. And I think to your point, Professor Thaler, that ironically where people actually overcome inertia bias and exercise some choice, loss aversion often leads to, as we observe it, poor asset allocation timing decisions that create, temporary losses to become potentially permanent reductions in purchasing power. And I think it's that bias that exaggerates in decumulation because it interacts with longevity risk.
Okay, thank you very much, Alison, for this. So, Roger, I have a question for you now, because Richard told us, we all have the tendency of buying high and selling low. Can we measure the cost of those mistakes and misbehavior in terms of performance? And just to put things in context, 3 years ago on this stage we had Professor Danny Kedalaman, And Professor Kahneman told us that through his studies, he realized the cost was at least 3% per year. So is it something that you can observe and comment on that, please?
Well, actually, let me comment. The way I've learned behavioral finance actually was from Danny Kahneman and Dick Thaler here. They're my teachers, so anything I say, you can blame on them.
They won't give you grades, so it's okay.
Well, but one way to measure it is how do people do, how do investments do with, say, cap-weighted portfolios or just buy and hold portfolios or any kind of portfolios compared with what people do. What actually people do, though, is they tend to buy after the rise and they sell after the fall, and this doesn't really give you the greatest returns, I guess, when you actually measure this. Several studies have shown that this is the result. Essentially, of course, people have, they don't want to miss out on things. I guess when we're talking about what the biases are, people, these are simple words, and we've talked about this in the investment community, but they're really behavioral. People have fear and greed. They're afraid of everything, and so after a fall, they really get afraid. But after the rise, they're feeling like they've missed out on something, and they need to participate in that. So and of course, people extrapolate all the time. And so they imagine that whatever has been happening will continue to happen. They don't view it from say, a value perspective, where you would say maybe just the opposite might be the case. Now that things have gone up so much, maybe they're too high, or now that things have gone down, maybe they're a good deal. So those are the kind of things that I see in these markets.
Thank you, Roger. So let's talk about what kind of solutions we can bring and help individual investors and savers. So, Richard, how can we help people stopping harming themselves through wrong behavior or misbehaving, as you put in your book?
Well, I think the statistic that you mentioned, that only 12% of the participants in Australia have ever done anything, should keep that in mind. I can give you a similar statistic. At the University of Chicago, we used to have 2 record keepers, and we decided to have them bid against each other and pick the cheaper one, and that meant some of the faculty members had to change the funds in their plan, and thought that the central administration knew what they were doing, and they knew who they were dealing with, and so they tried to match what you had before to the closest thing, but you could switch. The last time I asked, a grand total of 3% of faculty members had done anything. So inertia is big. And what does that mean? It means that the default investment strategy is crucial. Because if you have one, almost everyone will take it, and they won't do anything. And I did a study recently on the Swedish social security system, which has a partial privatization. They had a default investment fund which started out being great. Then they decided to add 50% leverage, which was a little scary. And as far as we could tell, about 3 people in Sweden noticed this. So no matter what you do, there was another fund that committed fraud, was on the front page of the newspaper, and the investors in that fund just stayed there. So the burden is on the plan designers to create good defaults. And I see no other solution.
Thank you. That's a fantastic transition to you, Alison. You design solutions, you offer solutions. So tell us how you can deal with that, and through your solution design, you can help your members.
Well, I feel very comfortable because I'm actually going to agree with the Nobel Prize winner. I think you're completely on the money that there are two solutions, and the first is the default option and the design of that product. And we believe, and we're in the process of implementing a product option that resets members' attention away from inputs to outcomes, which I think is the purpose of a well-defined default option. And that's in the form of a life cycle product that automatically supports a saver from their first paycheck all the way through to their last drawdown in their pension. I think this mitigates against inertia, against short-termism, against loss aversion, and against the natural tendency to oversimplify, for example, around costs, when faced with inaccessible sort of concepts like risk-adjusted returns, for example. And I'd argue that the opportunity to realise an ambition to create retirement products of one has never been enabled as well as it is today, with technology tools providing big data capability to really gain insights into the utility functions of our members. So I think that is the primary idea. Now, in Australia, we do have a choice architecture. So the second best solution required to support savers with choice, I'd argue, is empathetic communication. But again, one that really resets towards outcomes, not inputs. And to give you an example of what we've been doing there and have initial success with, is we've been using simple disclosure dashboards and interactive calculators to enable each of our members to understand if they're on track towards a kind of retirement income that they desire, given their choices of investment option, contribution rate, and retirement date. And we also enable them to compare that to their cohort in our fund, which we find they particularly like. And the second thing we've been trying to do is to really demystify the information they require at certain life cycle touch points. An example of that is for our younger members. We engage with our younger members to encourage them to think in terms of too little contribution rate as a loss of tax benefit rather than a loss of current income. And our latest surveys have been very encouraging in that regard, because 90% of our respondents have said that this income focus is the most valuable part of their statements. 71% have said that it's improved their confidence in this kind of savings vehicle. And crucially, at least for me as a CIO, 65.5% of those respondents have said that it's actually helped them improve their potential outcomes.
Thank you. That's a very good example, very, very clear. Roger, you've been working a lot with financial advisors, especially in the US. I know you're very popular with them, and some of them use some of your strategies. So, as I was mentioning before, we can quantify 3% being the cost of misbehaving, having great ideas and implementing them in the wrong way or trading too much over them. So through your interactions with financial advisors, what do you tell them? How to deal with that with their clients? What can you teach them to do? What kind of discipline you tell them? Drawing a financial plan, a plan do review. It's very interesting for us to hear from your experience there.
Yes, I would say right away that in most countries you really have to depend on the financial advisors to provide the education or to steer people in the right direction. Perhaps in Australia it's great that you're accomplishing so much in Australia, but it's not the standard thing that seems to be happening around the world. You can't count on regulation and the organizational setup to actually set everybody in the right direction. And we've all got, I guess it's been mentioned now, we all have this inertia. I guess most of us have great trouble at times making decisions. So some of us have inertia, some of us are impulsive. Probably though most of us are both have inertia and are impulsive. We can't make a decision, but when we do, we make it impulsively. So, well, yes, so it's sort of up to the financial advisors here. You're likely to have a better way of doing this. I'm not saying the financial advisors are free of our behavioral biases, but at least you've been trained and you know the problems here, and you listen to Dick and so forth, and so you have a better perspective on this. Essentially, you're the main row here, and you need the discipline, and a lot of this is just being informed and being educated as to what are the behavioral biases and how do they work. And once you understand them, it's easier to be rational yourself. You're in the business of trying to be more rational and trying to overcome these behavioral biases. One of the things I personally was involved in was I've done a lot of data, of course, over my life, and I guess I'm most famous for stocks, bonds, bills, and inflation, where I have a chart. I'm most famous for a chart, actually.
One chart.
Yes, I guess I could sum up my life in one chart, but the chart shows that the stock market really, with exponential growth, does so much better than the bond markets and the bill markets and inflation and so forth. And once you just hand people that chart, and even retail investors immediately say, well, I want to be in stocks too, because stocks really have a big payoff over time. So educating them and presenting information in the clearest possible way, it pushes them into the right decisions. But of course, all of you here, that's really what you're doing, especially if those of you who work on the retail end in any way, because you're actually helping the people with these kind of biases into actually acting more rationally.
Thank you, Roger. Richard, would you add something? Could we say financial planning is a kind of life policy against misbehaving, and that policy will worth, let's say, 1% to avoid the 3% cost of misbehaving?
Well, we can hope so. Obviously, not all financial advisors are created equal, and some are better than others at creating solutions for their clients. There's a lot of art. I always say that a financial planner is half finance and half psychiatry. And the personal part, most financial planners have not had formal training in that, but how you convince your clients to stick with it in the downturns and not sell off all their stocks in 2006, 7, and 8, and then miss the market going up. In the U.S., retirement savers didn't start net buying of stocks until 2013, and the market had doubled. So, and one last thing, Roger's famous chart is one way of displaying that data. There are an infinite number of ways, and some of the research I've done has shown that two completely equivalent ways of displaying the same data can lead to widely different choices. So if you show that mountain chart, people are very enthusiastic about stocks. If you show them annual rates of return, that makes stocks look a lot scarier, and they'll put in about half as much money. They're both right, but which one gets you where you want to go?
Good point. So let's move on the second part, on focusing on financial professionals. investment managers, investment professionals, which are supposed to be super sophisticated, you know, and I say super, we are sophisticated, they are sophisticated, but still, could they be subject to some biases? And when you think about overcrowded trades, overcrowded bets, and some of the financial crisis we had, and overpricing of assets. So, Alison, from you are a CIO, you managing a lot of money, you running through governance with investment committees. Can the governance of investment committees lead to consensus, and consensus lead to a bias in itself? What's your experience there?
Yeah, thank you. Investment professionals are, at the end of the day, human too, and so subject to much of the same biases as the savers that we're tasked with looking out for. It's just that we have institutional structures around us that support us to take better decisions. And I think investor biases, at least for me, cluster into three broad categories, some of which refer to the comments you've made about herding and groupthink on investment committees. So those three broad categories would be, you know, a first cluster sort of create unintended misalignment between actions and outcomes. And there, I think governance, which is a bit of an overused term, is really important. So for us, our retirement benefit provider motive really drives how our organisation and human capital is organised. We're all remunerated at fund level outcomes that are relevant to our members, not on our contribution to implement a particular part of the portfolio. Individual benchmarks on sectors in that way are operational. They define the universe of opportunity. They're not behavioural in the sense that they're not measures of success. Our performance versus peers is considered an implication of the investment strategies we pursue for our particular member base and our investment motive. They're not an input in our decision making. So there's some examples. The second group of biases, I'd argue, cluster around things that cloud judgment in the face of what feels like constant uncertainty today. So quantitative models really help us start every conversation with, you know, valuation and opportunity cost rather than market pricing. So risk for us lies in the assumptions we're taking and in the gaps between our understanding of things, and quantitative processes help in that regard. But there's no discipline like the discipline of writing things down. So we also spend a lot of time documenting before we invest capital, you know, the motive and risk triggers that would force us to review or change our position. And that's reported to our board, and we buy into that as a way of grounding our decision making in our objectives, not in our sunk costs, if you like.
Thank you, Alison. So I'm conscious of time. So Roger, you recently published and started the concept of popularity. And you called it popularity bridging classical finance to behavioral finance, or behavioral finance to classical finance. And in that concept, you've disclosed about the concept of hot stocks and cool stocks. Can you tell us a little bit about that? You know.
Yeah, so I do have a new monograph or a book. You can call it either one, but it's published by the CFA Institute, so you can download it for free. So I'm not getting royalties on that. I guess you could buy a copy for $10 or $20, depending on who you buy it from. That sort of shows the fact that whether you buy it, I think, in Amazon for 20 or the CFA Institute for 10. That's
so
an
much
arbitrage.
for the efficient market hypothesis.
Yes. But the idea is pretty simple. It has to do with what we like, popularity, and actually, it's really the types of securities that are unpopular that have the higher expected returns. Because if you imagine a set of cash flows, and if we really like the form that they come in, we're going to give it a higher value. But if you give it a higher value, that means we're going to actually get a lower set of expected returns. And just the opposite, the ones that are unpopular are lower valued and have higher expected returns. And in classical economics, the main thing that has usually been talked about is risk. And of course, we don't like risk. So if things are risky, they should have lower valuations, but higher expected returns. That's what my chart shows. That's why I produced that chart. But we find that that isn't the only thing people like or don't like. People don't like, even in classical economics, people don't like liquidity, for example. I mean, people do want liquidity. They'll pay a lot more for liquidity. They don't like less liquidity. And so that's going to impact the prices. You can see it even very directly just in bond yields, which are liquid and which ones are not liquid. But it doesn't have to stop. There's no particular reason to stop with the classical here. We can move on to the behavioral. As long as you like, if we like something systematically like brands, then it turns out that we actually tend to overprice the brands, and they end up with lower returns, or just the kind of things, stocks that you don't recognize. The stocks that are in the news, we actually those might be the hot stocks. Those hot stocks actually tend to do worse than the stocks that we overlook. So it's bringing in both behavioral finance and classical finance. One concept covers it all. We actually have models, a popularity asset pricing model in there that is analogous to the capital asset pricing model and so forth. So I'm actually very enthused about this whole line of work here, and I think it can put everything back together again.
Thank you. Richard, so you've been talking about nudge and how we can influence through nudge the investment choices of individual investors. And but could we go? For the last 2 days here, we talked a lot about new utility function in finance for common good. How can we use utility function to fight climate change, for example? So this is the big question for you. Could we use behavioral economic and behavioral finance to create a better world? Can you nudge the investment money going to the good place to go?
Well, I should say I'm not particularly an expert on this topic, but in principle, the answer is obviously yes. Many people, not all, believe in climate change and would like to do something about it. And certainly many of those, if given the option, would choose to have a portfolio that was tilted toward green, especially if they thought that they wouldn't give up much in terms of returns. As you and I were talking about before, it's possible to think about this as a hedge, that by investing in green technology, the worse the climate change gets, the better your investments are going to do. That might be a winning marketing line.
Thank you. So we just left 2 minutes. I'm going to ask you to conclude, each of you, what would be the key ideas, the 3 key words we need to keep in mind at the end for our audience, at the end of our roundtable. So starting with you, Alison, how can you summarize in few words?
I think in terms of outcomes, not products, would be the key message for me.
Thank you. Roger?
I guess my key word is Amundi here. I think it's really great that Amundi has taken such an interest in behavioral finance, and I think they're an example of firms that really are looking into really having a better understanding of how markets work.
Thank you. Thank you, Roger. Richard?
So here would be my takeaway, which is everybody thinks that biases describe what other people do. And all of you have the same biases as everyone else. We know that plan sponsors, the funds that they fire do better than the ones that they hire. And
there's some investment consultants in the room, so.
Yeah, well, They all have the mantra, past returns don't predict future returns, and then only recommend asset managers who have great 3-year track records. Yeah. So the other bias I think all investment managers have is they think that they're superior because they're smarter than everybody else, and we know that can't be true for everyone.
Well, with that, thank you very much. Please join me in a round of applause to our great moderators.